Sebastian, it's a great pleasure to have you on my YouTube channel. My name is Matthias, and you are the head of global M&A at FLIPPA, as far as I'm correctly informed. Today, we are going to talk about the M&A trends in 2025, and I think you have a very, very important position at FLIPPA and a tremendous overview on what is going on in the M&A market currently, because 2025 is a very, very important year. There is a lot of change with the view on the last 5 years, I guess, starting with COVID, where it's a tremendous hype, and afterwards there's a downturn. But first of all, just tell you who you are, what you are doing, and then start off with the questions.
Sounds good. So as very accurately pointed out, I help run strategic advisory here on a global basis. I spent most of my lion's share of my career in finance, with a lot in tech. So just a quick background. Been running advisory here for 2 years, and prior to that, I worked at two aggregators, or two private equity funds rolling up Amazon brands, and collectively deployed around $400 million. Went through the YC program, kind of understood sort of the nuts and bolts and mechanics of getting a deal done, and rolling out operations and some of the pitfalls that come with that. Prior to that, I was at a company called Clearco or Clearbank, which is the largest revenue-based financing fintech in Canada, largest investment that SoftBank has ever made in Canada. So we scaled that from around 15 people when I started to about 700 or 2.5 billion valuation. And then prior to that, I worked in London at an IR firm. So I've kind of been through I say every angle of this. So I've underwritten e-commerce brands or brands in general. I've bought and sold. I've operated. Just sort of seen the full cycle, and obviously gone through 2018 all the way through and seen the ups and downs, the peaks and troughs, and we have a pretty good comprehension on just how valuations are changing and flowing. So hopefully that's a decent background.
Absolutely. Based on that background, I think it's even more interesting to get your view on what's going on currently. But can you give just a little introduction on what is FLIPPA doing for those who have never heard of FLIPPA actually?
Fair enough. So the basic talk track, or how we like to position ourselves, is we are the investment bank for the 99%. So what this basically means is we democratize access to M&A advisory. So what I didn't say previously is I actually did do a short stint as a managing director of a boutique investment bank in New York. And so if you look at the primary differences between traditional investment banking and FLIPPA, we provide a simple, seamless solution that allows any founder of a business of any size to be able to go to market, and to be able to access a global directory of buyers. So the idea with FLIPPA is that we are the world's largest platform or marketplace for the buying and selling of digitally native assets. So that can mean YouTube, crypto, SaaS, e-commerce, content, anything that's digital or digitally native, we're able to sell on the platform. And the way that we're able to do this is through immutable data ingestion. So we have API calls that allow us to look at a business and very quickly ascertain, directionally how valuable that business might be, and then obviously cross-reference that with the P&L. And a buyer is able to get some strong directional accuracy and confidence on an asset. So a little bit different than the traditional banking model, which is a little bit more manual. We're utilizing a lot of AI, a lot of automation, a lot of data ingestion, and this allows us to do M&A at scale. So that's the biggest sort of, I would say, roadblock in M&A right now, is how do you do micro M&A at scale? And that's where FLIPPA comes in. So we are a turnkey solution, turnkey platform. So we offer, the legal services, the escrow services, the due diligence, the operation due diligence, the advisory, the insurance, everything you need in order to transact safely and transparently.
Very interesting, especially based on the background that investment banking usually is just secured for the top 1% of business owners. And how did you set up the entire structure to realize the investment banking for the 99%? Because it's still very working intense, and there's a lot of stuff to do to make business transactions in this space even happening. So how is the tech stack behind FLIPPA, and how did you build up, and when did you start to build up all this?
Good question. So I will just add a caveat here to my response, which is I'm not that tech enabled myself. I'm not privy to some of the inner workings, minutiae of our tech stack. However, I understand obviously of how things operate. So FLIPPA came actually organically as it's not actually a startup. I mean, we are a startup, but we're not. We're actually 15 years old, and we started by selling website domains, and then naturally just added more and more asset classes to the platform. And basically, we just tried to find a way. How can you really quickly understand the core fundamentals of a business. And when everything is digital in nature, what are the API calls that allow you to parse that information quickly? And essentially, we just kept adding and stacking to provide a larger suite of services so that the solution is seamless end to end. But again, I actually wouldn't necessarily know how to talk you through the genesis of each, tech integration that we decided on. But basically, our North Star is always what will automate, what will make it streamlined, what will make the UI very intuitive and simple, what will allow buyers to engage with assets in a way that's frictionless. So I'll give you an example. In investment banking, you have what's called the SIM, Confidential Investment Memorandum, which is sort of like a snapshot of a business. And traditionally, you have analysts that will parse through a business's data, their financials, and they'll create a very nice presentation that allows you to kind of understand all the benefits, usually done through a PowerPoint or something. The reality is that you have to make those per asset or per project. It can be quite time intensive, and usually sort of delays getting to market by roughly 1 month. Well, with FLIPPA, we realized that you could automate a lot of this, and you could standardize a lot of the format so that buyers don't necessarily need to look through hundreds of SIMs, but you could sort of automate the push so that a buyer can go into FLIPPA and they can literally put, these are my buying criteria, this is my thesis, this is what I'm looking for, and immediately get, let's say, 100 different options in a very sort of digestible, simple format. Whereas with traditional investment banking, you're looking at a SIM and you're sort of having to go through, each SIM is a little bit different. Now, candidly, with AI and with automation, we are seeing a lot of sort of flattening in the process. But yeah, I would argue that is a core competency that we have that allows us to do things at scale.
Very interesting. And I think what differentiates FLIPPA from the traditional investment bank is just the amount of data you gather over time. Because
Correct.
at the traditional investment banking is, I think, very subjective. I've been working in investment banking for the Hypo Vereinsbank or Hypo Group, and it was always very subjective because you get the data and there is just one deal probably at the month and it's probably 12 deals a year. But if you are transacting thousands of deals every year, you have very, very accurate data at the status quo. And what is your view currently on all the transactions you're overseeing? What are the major trends in the different sectors? Which sectors are very hot, which are probably not so hot? And what is the relevant data you are extracting compared to your past, where you have been working in traditional investment banking? And what is the major difference in your perspective?
Lots to unpack there. So let's start, I guess, with step one. What are we seeing? Well, first off, we are seeing a huge expansion in the multiples across various sectors. Arguably, the biggest improvement since, let's say, 2022 and even 2023 has been e-commerce. So there has been a significant and remarkable recovery in the valuations of e-commerce businesses. I don't pretend to know exactly what the motivation is of this, but I will say that we're seeing a continued expansion in cross-border transactions. So previously, I think we were doing around 60% of our deals were cross-border. Now it's almost 80. So what that basically means is a buyer and a seller are located in different countries, and in most cases separated by an ocean, right? So we can see a buyer in the UAE that's buying an American asset or an APAC asset, or vice versa. And what huge, so I would say driver is we are seeing a lot of American liquidity looking for divestiture out of the US market just because of tariffs. Again, this is specifically related to e-commerce. So with the current administration being quite volatile in what their tariff policy is, we're seeing a lot of American private equity, high net worths, family offices, search funds looking for strong, robust cash flow positive businesses in e-commerce that might be domiciled in Europe or the Middle East, that are not subject to the pressure of tariffs, not having margin compression, and obviously have the ability to turn on access to the American market when necessary or when things become a little more palatable. So we're seeing a huge flow of capital from the US into Europe, which I think has been a pretty big tailwind currently. And so I'd say the valuations in e-commerce have gone from where they were in 2022, which I would argue was the lowest I've ever seen, which is kind of like 1x EBITDA to even 2x EBITDA if you're lucky. And now we're seeing things kind of settle more around the 3 to 5 range. 5x being, something very robust with strong CAGR and relatively defensible margins. But yeah.
Yeah, it's very interesting. I got the current data from e-commerce in here because we are solely focused on e-commerce transactions. And in the mid-cap range, it is a range from 5.2 to 6.8 EBITDA multiples. And in revenue, it's already 0.5x to 0.84, which is tremendously higher than in the past. But what is really
Correct.
interesting is the capital flow from the US to Europe with the background information of how the US dollar to the euro with the exchange rate is not so good for the American investors. It's very good for the European investors because it's a strong euro and a very weak US dollars. But do you see any implications from the exchange rate between the euro and the US dollar?
Candidly, no. And this
Okay.
simple reason is in micro M&A. I think let's make this distinction now. So if you talk lower middle market, I mean, arguably in e-commerce, it's obviously going to be a lower threshold. But let's just say that lower middle market is, I would say, 30 to 100 million in revenue. And micro would be anything sort of sub 30. In reality, anything sub 20 million would probably be micro M&A. And candidly, at a deal size of let's say 1 million to 10 million in revenue, uh, FX is a consideration, but it's just not that much of a consideration when you look at tariff pressures or supply chain pressures or other downstream pressures that are have much greater impact on margins moving forward. And at the end of the day, the FX is a snapshot in time, right? So if you're purchasing an asset,
Mm.
that FX is a one-time hit versus maybe thinking longer term. But there's also tools available for hedging. So I don't think it's not been as much of a friction point in negotiations is FX. What is definitely a friction point in negotiation is where are the goods being manufactured? Where are your primary markets? What channels are you using? What is your AI strategy? How are you automating? Give a great example here. We're seeing a lot of margin improvement in relatively larger micro M&A transactions due to a lot of customer service automation. So Sierra, and other sort of, I guess, fully autonomous agents. So the agentic age is allowing a lot of e-commerce businesses to do returns and reverse logistics very well and improve their margins in there. Because again, that's a huge pain point for a lot of e-commerce businesses. It's just margin compression on reverse logistics. And I'm just starting to see a lot more conversations around what are you implementing in the age of agentics versus FX considerations. I just don't think it just doesn't seem to be as much of an issue.
Very interesting, and it also doubles down on what you have already said, that investors are looking for real assets with a high cash flow and very, very high level of stability. What defines monetary stability or financial stability in your perspective with the view on e-commerce businesses? Or why do you think is a e-commerce business stable or unstable based on their projection for 12 to 18 months?
Good question. I think first off, let's make a huge distinction between an Amazon FBA business and a Shopify or Magento WooCommerce, BigCommerce, because I think if we don't make that distinction, it's hard. One is a marketplace that is passive. One is digital real estate. So Amazon operates as a digital storefront. Traffic is being driven to you. Everything is opaque and processes is opaque. So you don't control the keys to your castle, right? Amazon controls the keys to your castle. You are
Yeah.
but a passenger. Now, the startup costs and the ability to get into market and start driving considerable cash flows is easier with Amazon, but you're never going to break through that margin ceiling, right? You're always sort of beholden to the behemoth that is Amazon. Whereas with Shopify or with D2C, you are the controller of your own destiny, right? That is your brand. You have brand equity. You have an email list. You have an ability. You have zero-party data implementation. Like you can understand a lot more about the journey, and therefore you have a lot more impact. So if we talk about just D2C and not Amazon, then I think what makes a brand really stable and interesting is obviously, how much brand equity is there? Is there a utility patent? How much IP is there? What have they built a community? What kind of social engagement do they have? How are they monetizing the engagement? How are they thinking longer term about bringing customers back? We need to see a robust sort of full cycle strategy, and not just, hey, I'm selling, AirPod cases. It's got to be something a little bit more real and tangible. Of course, if there's a subscription piece or a repeat buyer piece, and then things become very interesting, and that moat is a lot harder to assail than some of these more, I would call them, drop shipping businesses. Like obviously, if you're not fully owning the cycle, then I think you're probably not going to get the valuation that you might hope. But a fully owned D2C where you've been in the market for 5 years, let's say, you have relatively strong CAGR, say 30%. You're being very cognizant of your reverse logistics strategy. You're very cognizant of your social media strategy. You're utilizing micro influencers and just understanding your ROAS. I mean, yeah, that's a business that we see going on the higher end of the multiple spectrum.
Yeah. Compared to the past where growth has been the major driver for valuations, why do you think growth is not that important anymore and stability is even more important in regards of what is happening in the world currently? Because there is so much volatility in the market, political volatility, economical volatility, social volatility. How do you think that shifted over time, and do you think there are certain stages in shifting over the last 3 to 4 years?
Okay, so I absolutely agree. There has been a huge shift, but I think we need to understand the genesis or the sort of the starting point, the origin of why growth at all costs was the sort of the paradigm. We were in a zero interest rate policy for a very long time, quantitative easing, etc. And in that, there's no risk premium, right? So you need to deploy, you need to grow because candidly, interest rates were so low, and just there's no risk adjusted profile. You just have to do whatever you do to grow. And so that was an artificial environment. And I think as that started to taper off, we're seeing a lot more people understand that, hey, businesses are actually based on fundamentals and not just cosmetic growth. We are seeing also, again, as interest rates rise and the risk-free rate of return rises, then there needs to be, you need to show that you have resilience. Otherwise, it seems very much like you're buying very temporary cash flows or very indefensible cash flows. And that's, from any perspective, it's very risky. So, I think, look, we saw this unbridled enthusiasm with e-commerce during COVID. Obviously, that was artificial. We saw a supply side recession that was artificial. All of these things have come off, and we sort of recovered. And but I will come back to one point, which is I actually am starting to see growth become important, and there's a simple reason why. Revenue is revenue, profit is profit. But if you don't have the input as revenue, then you can't adjust the profit downstream, right? So you can reinvest for more growth, but that's an easy knob to turn to profitability. So yes, stability is great, and we are seeing a lot more interest in stable businesses. But if you do have a high growth profile and maybe a low profitability, because they don't technically go hand in hand, that is starting to become valuable again. I think that again comes back to you can do a lot more with a high revenue base versus a low revenue base, even with higher profitability.
Yeah, very interesting. How are aggregators and PE firms shifting from volume-based acquisitions to more selective plays in the past?
So I can tell you firsthand as being part of two aggregators, one that imploded. So they raised about 140 million and all of that went to zero. And then the other raised about 200 million and is now operating at around a 300 million revenue a year run rate. Candidly, I think the aggregator space was the financialization of e-commerce with not a strong comprehension of operations. So it was all about deploying capital because candidly, there was a lot of covenants and warrants and fine print on the debt that was being issued. And there was a timeline in which they needed to deploy this. And so that kind of went away with caution through the wind. People were just acquiring for the sake of acquiring, because when you breach a covenant on your facility, you may not have access to that drawdown anymore, and yet you're still paying interest on it. So there was a sort of an unnatural urgency to deploy, which I think just pushed into a bit of a frenzy. And that's kind of what created a lot of the frothiness with the aggregators. So now that reality is hit, and it's true that operations and operational, I would say expertise and is really what is the secret sauce. It's not financialization. It's not, interest rates. It's not cost of capital. It's not WACC, none of that. It's really just how airtight you are on your supply chain. We've seen aggregators really focus on the right type of acquisition and paying the right price. So entry point, I would argue, is as important now as the actual overall health of the business. And they are looking at things that are very synergistic to their current portfolio. There's no sort of conglomerate play anymore. No one's trying to own the market. The sort of Thrasio model, completely gone. It's very much let's focus on 1 to 2 verticals. Let's own that vertical. Let's look at being on every platform possible. So they have to have proficiency in not just Amazon, but Shopify, even TikTok or other revenue channels, and understand that and understand the interplay between those. So we have seen a lot of aggregators and PE funds saying, okay, our remit has gone from the whole world to very, very narrow. But fortunately, when they're ready to deploy, they deploy very quickly, and they're very their confidence and their conviction on an asset is razor, and they just go all in. So we do like that, and again, I am seeing more liquidity come back into the market. If the Fed continues to drop rates, I think we're going to see a lot more. But yeah, let's see. Time to be told.
I think that is to be expected, that the interest rates are going to go down.
I would argue the opposite on that, to be honest with you.
Really?
I don't think the Fed's going to cut in October. I think, especially with the shutdown of the government, there's no data. Powell is he's very, very risk averse. He's not going to make the wrong decisions. Candidly, the tariffs are highly inflationary, and if anyone says otherwise, they don't know anything about economics. The reality is that most of these corporations have not passed on cost to consumers yet. They're waiting because there's been such a mismanaged policy that nobody knows what to do. So you're not going to pass on cost to consumers yet. So there hasn't even been inflation yet. None of it is even felt yet, and it's coming if these tariffs are upheld by the Supreme Court. If they're struck down, all bets are off. But if they are upheld, that pretty much puts no check on the executive branch's power, and therefore you'll see a lot more tariffs, a lot more craziness, and so inflation, I think, will tick up massively. And so, yeah, I would argue interest rates are probably not going to come down.
Okay, very interesting. Very good argumentation too.
Let's see.
We have talked a lot about the macro economic drivers in the space, but what I want to know, and that is also something our clients want to know, is what are the strong listings on your marketplace all have in common? Because all of our clients are or give us the mandate to just improve the finances. We are focused on e-commerce finances and improvements of those e-commerce finances, and everyone wants to know, despite the fact that they all say, I do not want to sell, they want to know what they have to do to be able to sell. So it's like a little complicated question, but what do you think is very common among all the e-commerce listings that are successful at FLIPPA?
Very good question. I wish I had a secret playbook, but I will walk through some of the core points or tenets I think make a very compelling listing or compelling asset. But one thing I will note, because you made a point about this, which is everyone says they don't want to sell, or maybe they don't want to sell now. I think selling and fundraising are very much in the same vein, and it's an evergreen function. You constantly need to be ready. And I think you should always be, as a founder, should always be on a foot of preparation. So I think it's a very healthy and hygienic process to go through and make sure that your business is always ready to be sold. That being said, what makes a really good listing? Look, I want to see, or me as the collective buyers want to see relative longevity or maturity in a brand. So 5 years is great. Sub 3 years, it's very hard to ascertain if that is a trend or if they're just really sort of capitalizing on whatever is in vogue that moment. We want to see margins around sort of at that 20 to 25% range. We want to see something defensible about sourcing. So, if you have a product that is coming straight from China that is very repeatable or replicatable, and really the only sort of defense is the brand itself, that can be problematic. If you've done something to garner some sort of differentiation in the market, that's really helpful. If you're, again, very tight on your marketing. So obviously marketing is the lifeblood of all businesses. So ROAS is important, but understanding zero-party data and understanding how customers actually find your business. So being able to articulate your marketing strategy more than just, hey, Google Analytics says I'm doing this. Because candidly, Google Analytics is a catch-all, right? People might see your brand on TikTok, or they might see your brand on Instagram, but they type into Google the brand name. So Google takes basically the credit for that sale, when in actuality it wasn't Google at all. Google was the vehicle to find the brand, but it was actually the discovery came through another social media channel. So as a founder, how should you be allocating resources? Should it be more Google, or more meta? Well, arguably it should be more meta. So if you understand zero party data and you're making a point to engage with your customer base and you're going further than just this sort of out of the box table stakes analytics, that shows a high level of competency, and buyers are very interested because that means, hey, this founder fully understands their customer, and they're going to the source, which means there's a lot of possibility for improvement and nurture. We love to see founders that understand how to nurture their email base, their database, and how to bring people back who understand discount codes, things of this nature. Again, look, revenue is obviously going to be king in the sense that revenue gives you ultimate optionality to play with the business. No high concentration on a single market, right? So obviously, if you have a hero, ASIN, or SKU, and that kind of dominates 80% of sales, that's going to be very problematic. Same if you're in one geography, which if you're in one geography, it tends to be the US. So that's why I think right now it's overly problematic, but maybe that's not necessarily a long-term situation. But for those that are selling into the EU, like if you're able to sell into the Benelux region, the DAC region, the Anglophone region, that's great. If you have diversification of geography, that's great. How are you looking at new product development? What's your pipeline of new product development? Are you hoping that your hero ASIN will be enough to just kind of ride out the next 5 to 10 years? I mean, if then you just have to sort of think about it as a discount. How much is that gonna discount down, and what are buyers gonna look at that, and how are they gonna value or underwrite that? Does that make sense? Hopefully that's
Absolutely, absolutely. And I want to complete the question with another question, which are the absolute red flags you see over time with deals that are not going to be transacted because of those red flags, if there is a certain attribution to those.
100%. So under a year old is basically almost a no-go. Candidly, a lot of debt providers won't even underwrite businesses that are less than 3 years old. No taxation, right? So they haven't filed their tax returns. Domiciled in relatively unfriendly geographies. Those go without saying. But hostile. Inability to articulate a balance sheet or talk about how you paid yourself, unnecessary adjustments or add backs to the P&L. It's okay to add back things that are reasonable. Like if you're leasing a car through your business, and yeah, it's a reasonable add back, and it's a personal car or whatever the case may be. But again, sort of trying to add everything back and sort of inflate the adjusted EBITDA to a base where it's comfortable. No, I mean, most buyers will see right through that, and it's very hard to defend those adjustments as a founder. And so you'd rather go to market with lesser EBITDA and a little bit more natural and less and more clean, I guess. Another thing would be highly commoditized spaces. So supplements are good, but if there's nothing differentiating your brand in the supplement space, you're just a proxy of your marketing spend. And so really difficult to buy that.
Does the differentiation has to come from the product itself, or probably also from the brand? Because there is a very famous transaction from the EU to the US, which is Raw Nutrition from Chris Bumstead. And I've been wondering why they did that. And it's just because of the brand Chris Bumstead, I don't know, 8 times Mr. Olympia, or why do you think does that make sense?
Well, first off, he's a Canadian. I'm a Canadian, so I give him a lot of respect. And I think with something like supplements, where it's high, again, you're unlikely to discover a new molecule. In fact, it's impossible. You're not going to rewrite the book on creatine or whey protein or whatever, or any supplement, omega-3s, etc. So yes, differentiation would come from either the exclusivity, the subscription base, the way that you engage, your social media campaign, your micro influencer campaign. Do you have testimonials that actually make sense? Time to delivery, return policy, sort of the nuts and bolts of like, why would someone want to buy whey protein from you and not just off Amazon? Is it because you can say that the quality of manufacturing is excellent? You can say it's made in Germany, for example, and pass the highest tests, and the whatever the case may be, right? The sort of the level of proficiency that's gone into reviewing is much higher than, say, a Chinese supplement. But yes, I think for something that's highly commoditized like supplements, you need a really robust strategy of not just, hey, I'm really good at social media, but it's also community. So I'll give you an example. We saw a brand that was a mobile app in the fitness space, but also selling supplements. And it was all geared towards CrossFit. And this founder actually founded a CrossFit gym in the UK. a series of CrossFit gyms and only sold his supplement in the CrossFit gym. And also there was an app that went with it. And so this whole sort of community engagement tied in really nicely. And there's just so many ways to, different sort of revenue streams per customer and per client. And he just understood how to tap into the zeitgeist of his community and bring them on board. And that itself is amazing. Because then if you're an acquirer, you say, hey, it isn't just a supplement, it isn't just an app. I'm actually getting the community. And that is true differentiation.
Very interesting. And you're talking about strategy. What I want to know is not just strategy, but also the structure and the deal structuring that is happening in 2025. What are the typical deal structures you oversee currently, especially in the Q3 or in the second half of the year? Because I think with the change in policy also in the US, there's a change in the deal structuring, but probably it's not too accurate if you consider all the deals you have seen over the year.
So I think what we've moved away from is a world where high cash at closing was the norm. And the reason is simple. Obviously, cash at closing essentially unloads unnecessary risk onto the buyer and de-risks the transaction for the seller completely. So in 2025, in the first half of the year, what we've seen a lot of is a structure where it's around 60 to 70% cash at closing, even sometimes less, and then very clear stability payments, milestone payments, earnouts, rolled equity or pushed equity, deferred payments, seller notes, any mix of these, so that the seller is obligated and motivated and has skin in the game, so that the brand and the asset is transferred as seamlessly and without any issue or hiccups, that they can be called upon if necessary for in the event of putting out a fire, etc. Obviously, non-competes, things of that nature. But I think ultimately what we're seeing is buyers understanding that they need this to be a partnership and a little bit of a marriage. It might only be for 6 months or a year, but the days of I'll just buy that business and that's that, those are gone. But sellers need to be ready and eager to work with the buyer, not just on the transaction, but on post, on integration, on handoff, which actually is something that might be worth noting. If sellers are thinking about going to market, creating the SOPs, the playbooks, the handoff documentation can be very helpful and critical and can sort of truncate a sale process and sort of get that money in your bank faster, which I think is something that a lot of sellers overlook.
Interesting. You've already answered the question partly, but how does the early preparation, especially clean P&Ls, SOPs, and standards like that, improve deal outcomes? Because everyone wants to start off a deal and evaluates how successful is the deal going to be, even if it is going to be successful. But what are the major drivers to make a deal successful, in your opinion?
Simple. Time kills all deals. Number one thing that every single seller should understand: time kills all deals. Whether it be the debt covenant, whether it be the timeline, whether it be cold feet, whether it be changing macro situations, whether it be going into a bad quarter, it doesn't matter. Time kills all deals. So you need to go into a process as a seller with a sort of warlike, combat mindset, which is how I need to get this done. It's do or die. And so how can you prepare beforehand so that the whole process is seamless and fast? So, for example, make sure your tax returns are up to date fully. I don't care how painful it is or annoying it is. And again, we understand that the tax return, you're going to optimize for the lowest tax burden. That's fine. Don't worry about it. A balance sheet is necessary, but not necessarily mandatory in the beginning. Quality of earnings if you're over 10 million. So, pay an accountant, go through, do QOV, make sure that there's a really clean understanding of the business, hierarchy, SOPs, understanding, what your supply chain looks like, start to finish. Who are all the major players in your supply chain? What are their contact information? All these details need to be prepared beforehand, so that when a buyer says, "I've set up the digital deal room or the data room, please submit XYZ spreadsheet," on the spreadsheet that they usually have, you can tick all these things off immediately, and you go from what might take a 30 or 60-day close. You're giving all that information and you're front loading it for the buyer in the first, let's say, 24 hours. That shows that A, you're professional, B, you're serious, and it puts everything on the buyer to then transact quickly. And at the end of the day, that is what's going to get deals done better, faster, and easier. And everyone comes out happier.
Yes, and it all. I think all you said is just reduced to the sentence. The best business to sell is the business you do not want to sell. Actually, and if you have a business you do not want to sell, and there's an alternative to just grow it, when do you think is the right time to consider raising capital instead of selling outright?
So I think raising capital is a very complicated question just because we're talking about e-commerce. So if this was SaaS, I think it's a completely different argument. But because you're focused on e-commerce, let's drill down on the fundamentals of raising capital for e-commerce. At the end of the day, the primary use of that equity capital is going to be marketing. And I'm biased because I worked at Clearbank and our whole point was to democratize access to fundraising, but also you shouldn't be using equity dollars, which are the most expensive dollars you will ever use, on marketing. It just doesn't make sense. It's not a logical or good use of capital. So I think in e-commerce, if you're fundraising for product development or if you're fundraising for something longer out, then you definitely should consider it. But it needs to be more about strategic partnership and not just about getting money in the door. Where I am now, and I genuinely believe there are other vehicles that are better suited and for, let's call it stopgap financing, revenue-based financing, invoice factoring, whatever the case is, inventory financing. There are ways that you can bridge your cash flow gap that you don't need to give equity on. But again, if you're looking to raise equity because you want a strategic partner, you want to invest in a new geo or in something where the return will be much longer and it's not going to be as quick. Start with marketing, put $1 in, you get, let's say $3 of revenue back out, and you call it 30 days. Yeah, you don't need equity capital for that. But if you are looking to do something that is much longer dated, then equity financing can be phenomenal. But again, I come back to, you should raise equity when A, you can't possibly grow any faster organically, or B, you're looking for a strategic partner that only can be had through the partial sale of a business or the sale of shares. C, if you're really under the impression that you can get a 10x or 50x return on that equity dollar, then I think it's also prudent at that point. But it will come down to the per case basis for sure. Every e-commerce business is slightly different.
Okay. So Sebastian, thank you so much for taking the time today and all your very precise answers on all the questions I have had the chance to ask you. Wish you a great time in Munich. I know you are in Munich. Great event tonight, and hope to see you soon.
Me too. Thank you so much, man.
Thank you. Bye.